Hope we're going to have a pretty productive session. So before we get started, I wanted to just ask everyone to keep their phones on mute. Anita, can you mute everyone's phone? Okay, great. So before we dig into this topic for today's seminar, I just wanted to brief you all. Some of you are new to Barossa. I just wanted to let you know what we're all about and what we're trying to do. So essentially, Barossa Club was founded on the vision that financial literacy is the most important thing when it comes to using financial services correctly. If you have understanding, you're able to make better decisions, and that's what we're all about, trying to get our members to make better decisions in their financial lives through understanding and trying to make finance simple and fun to learn. So this is a special session because it's the first session that we're doing that was member requested. And I would love to see more recommendations coming in from members about what they want to hear about. So obviously this is a very trying time for everybody. So, the whole COVID situation is putting a lot of uncertainty into the world. And some of you who are Barossa members have seen that we are managing our portfolios in a certain way that indicates we're pretty conservative right now. This session is not about what we think. It's about the framework we used to come to that decision. And you may disagree with us in a lot of places, but what I hope you take away from this video is how to apply this framework to do what's right for your portfolios. And if you walk away with that, that's far more valuable than walking away with whatever one person or one group of people think is going to happen in the future, because nobody has a crystal ball. And as long as you walk away with understanding, you will be able to make the right call for you and your family. So why don't we get started with the material? So hopefully everyone can see the screen share. Just give me 1 second. Okay. So in this session, what are we going to cover? So we'll start with a brief description of the economy and how it works in a perfect world. And this is going to be focused on making it a very intuitive, understandable description of the world and the economy and how it works. Then we'll discuss how COVID-19 has disrupted the economy and what governments are doing to fight back, and what this all means for your individual portfolios. And we'll wrap it up with a Q&A session where you can ask your questions. And so to ask a question, since your lines are muted, please just use the chat box and feel free to type in your question whenever it arises. And we'll cover them at the end when we do the Q&A. If last session is any indication, we won't be able to cover all the questions. And in case we miss a question, any member can just email us at advisory@barossaclub.com and we'll come back to you with an answer. So we look forward to walking through this presentation with you. Let's get started. Okay, so the economy is highly complex. So the first step in trying to figure out what to do in a time like this is trying to simplify things to the nuts and bolts that really matter. So what we've done here is we've tried to boil down the economy to the core engines of the machine. So there are two main engines when it comes to the economy. The first is the private sector, so companies, and the second is the government. So let's look at the private sector first. So basically what companies do is they raise money from investors and banks who give these companies money to earn a profit from those companies. So the investors and banks give money to the companies in the hopes that they'll earn a return from, and which will result in profit on their investment. So how does this profit come about? Well, the companies use the money to produce products and services, and they sell these products and services in the marketplace to generate profit. In the process of creating these products and services, they create jobs in the economy. And these are the very jobs that create income that allow people to buy these products and services in the first place. So as you can see, jobs play an absolutely critical role in the entire system. If there weren't any jobs, there would be no one to buy products and services, and no way for the companies to return profit to the investors and banks that need it to earn their return. So jobs play the absolute linchpin role in the economy. If we look at the government side, it's very similar, except the revenue primarily comes from taxes. And even in taxes, it's jobs that provide a big share and company profits that provide a big share of how the government gets money. And in the case of the government, they use this money to create infrastructure, which is like, police or roads or, airports, etc. And in the process, they also create jobs for the economy. So now that we understand the basic nuts and bolts of the economy, let's move ahead to see what this looks like when things are working well. So when everything's functioning in the economy, there's a self-perpetuating cycle that results in very good outcomes for the economy. So you have job growth that results in spending, increased spending, which results in increased company profits, which results in increased company growth, which results in more jobs and more spending and more profits and more growth and more jobs. So this cycle is what results in the long string of growth that we see in economies over the past decades. So this results in investors getting repaid, tax revenues growing, infrastructure improving, and more reinvestment in the economy. So what has COVID done to the situation? So COVID has forced our hand. So essentially, because of the threat of the pandemic, the governments have been forced to institute lockdowns. And this lockdown prevents lots of companies from accessing their customers in the marketplace. So if you're running a restaurant and your customers are locked down, how do you sell your products? You can't. So you're in a situation where your revenue has dried up, but your expenses are still ticking. And this results in a situation where companies have to protect their profits. So if we go to the next page, we see that same cycle that promoted growth when the economy was functioning well is now turning into a cycle that makes it very difficult to get out of this trap. So we have a situation where companies can't sell their products. Because they can't sell their products, it creates job losses. And because of those job losses, there's less spending in the economy. And because there's less spending in the economy, more companies can't sell their products, and there's more job losses, and so on and so forth. And what are the consequences of this? Investors may not get repaid. Tax revenues will fall. So this looks really bleak, but how do we break the cycle? So what are governments trying to do to fix this? So governments are trying to do something called government stimulus. So what this basically means is what triggered the change in the cycle from a virtuous cycle to a vicious cycle. It was the fact that income left the economy because people were not able to sell products. So what the government's trying to do is they're trying to replace the income that was lost in the form of payments to customers, to consumers. And they're hoping that when that money gets injected into the economy, it'll stimulate customers to spend again and allow companies to be able to sell their products again and allow employment to come back. But the key question is, where does this money come from, right? So how are governments funding this? So if we go to the next slide, governments generally, this is not always the case, but for India and the US, it is the case. They earn their money through tax revenues, but they spend far more than what they earn through tax revenue. So they're operating in deficits. So how do they afford to spend even more? So they have two sources that they can tap. One is borrowing from investors. So they can go and borrow money from investors, like a company would borrow money from investors. So the investor will give money to the government and expect to be repaid. But this has limits. So an investor is also impacted by the economy. So there's less amount of investable money in the economy than there was before COVID. Secondly, investors are more weary of giving governments money in times like this because they're less sure the government will be able to repay them effectively. So governments are forced to also resort to creating money. So this is like basically literally almost printing money. So this basically means the government can run increase its money supply and just create money out of thin air essentially. But this also has some limits. Imagine if economy just printed money nonstop. The money would become worthless because you're just creating lots and lots of money, but you're not increasing the amount of real goods that are produced in the economy. So printing money has the effect of weakening the currency. So on both sides, you have limits on how much money a government can pump into the economy. And you kind of see this in the next chart in terms of what the response from India has been to the crisis and what the response from the US has been. So let's analyze a few numbers here. And I promise you this won't be tough. So let's start with the line stimulus announced, billions of dollars. So this is what's been publicly announced by India and the US. More stimulus may be on the way, which is not factored in here. But based on what's been announced, India has announced 20 billion of stimulus into the economy, and the US has announced $2 trillion worth of stimulus. The next line, cost of living adjustment. So we all know that goods and services are cheaper in India than they are in the US. So basically, what this line does is it adjusts for that. So the typical factor that most people use nowadays to adjust for the cost of living is 4. So basically the 20 billion of stimulus that India is putting into the economy, actually when you adjust for the cost of living is equivalent to 80 billion US dollars. So when we compare that 80 billion to the 2 trillion that the US is putting in, and we divide it by the number of people in India and the number of people in the US, we're able to see on average how much help is an Indian citizen getting and how much help is a US citizen getting. So when we look at the US figures, a US citizen on average is getting 6,000 US dollars of stimulus help. An Indian citizen is only getting $60 worth of stimulus. Why is this? So a developing country like India does not have the credibility with investors to be able to fund a lot of stimulus. It also doesn't have the credibility in its currency to be able to print lots of additional money. So as a result, it's constrained in how much it can put into the economy. So even if India comes with more stimulus dollars, it's unlikely that they'll get anywhere close to the levels that the US is providing its citizens. So if we move to the next slide. So one of the key questions that we need to answer now that we understand this framework of how the economy works, what's gone wrong, and what the government is trying to do to replace the loss in income is we need to understand how much is going in and how much is going out. So let's look at this in 2 chunks. How much will we lose in terms of productivity? So if we look at the lockdown, it's approximately 1 month in duration based on what we know today. It all could always get extended longer. There's a chance it could get cut short also, but based on what we know, it's looking like roughly a month in duration. Also, I'm going to just assume, and this is just a pure guess, and you can put whatever you want in here to run your own analysis, but I'm assuming that the lockdown causes a reduction in productivity of 30%, basically meaning that 30% of the economic activity that would have happened stops happening because of the shutdown. So let's figure out what that means in terms of actual economic impact. So India's monthly GDP is roughly $250 billion a month. So if we say that the loss is 30%, like I assumed, then you take the 30% times 250 billion, and you get a 75 billion hit to the economy from COVID-19. So when we compare that to the announced stimulus of 20 billion, it's very clear that the economy with the inflow and outflow is going to be a net loser because the loss is greater than the stimulus. Now, obviously, the government can come out with more. You may think the impact is less, but this is the framework that you can use to try and estimate how much short-term pain there's going to be in the economy. So, okay. The next question probably on a lot of your minds is, what about the stock market? So there are a few lessons we can learn from history. The first is, don't rely on the market to tell you if things are getting better or worse. When we look at data of, for example, the great financial crisis that happened in 2008, you see lots of fits and starts. You see lots of rallies that faded into further downturns, you see market overreactions in both directions. Financial markets struggle to process information in times like this. So don't look to the market to make your conclusions. The best way to make correct decisions in times like this is to form your own conclusions based on what you see, what facts you see in the papers, what your thoughts are and projections are for the future, and then compare them to the market. And that's where you can identify opportunities. If, for example, you are feeling that prices are going up in the stock market, but you're feeling that things are not really improving, then maybe it's telling you you need to reduce your exposure to the stock market. Or conversely, if you assume that things are going to get better, but you see stock prices going down, maybe it's time to buy some equity. So that's one lesson. Try to divorce yourself from the stock market prices. The second is we can look at the average valuation of stocks. So how expensive or cheap stocks are. For beginners, I'll just cover how we tend to do this. So when you're looking at a stock, one of the most common ways to assess if a stock is expensive or cheap is looking at the price to earnings ratio. So the price to earnings ratio compares what an investor pays to buy a stock and what an investor receives in return for buying the stock. So the earnings share that he gets for the price he paid. So the higher that ratio, it means he's getting less for the same amount of money he's putting in. So the higher the ratio, the more expensive stocks are. The lower the ratio, the cheaper stocks are. If we look at the average Nifty PE, it's been 20 times since 1999. So that means a stock has typically costed 20 times the earnings you receive in return. If you look at today's level, it's also 20 times. So the key question is, the market is assuming an average level of risk today. What do you feel? So that's the key question. If you feel like we're in an economy where the risk levels are average, then it's fairly priced. If you feel like we're in an economy where the risk is higher than normal, then maybe equities are expensive. Or if you feel, no, there's a lot of upside, we're going to rebound from this thing really quickly, then you may feel like, there's a below average level of risk. So if you go to the next slide, how do you assess risk? And the key to assessing risk is asking questions. The more you ask these questions, even though you won't have concrete answers, it'll give you an intuitive feeling of how risky something is. If you struggle to answer the questions, if you really don't know, if you're worried about any of these questions, it tells you something. Or if you don't feel those same concerns, then it tells you that maybe, things are not as risky as you think. So what are some of the questions we were asking ourselves? So on the macroeconomic side, how long will it take to get back to normal? And normal here means truly normal, what it was like before the lockdown and before COVID-19. Will we have recurrences of COVID once the lockdowns are lifted? Will the government announce additional stimulus measures that bolster the economy more? How efficiently will the stimulus be spent? So it's one thing giving money into the economy, but is that money going to the right people? Is it going to be recirculated in the economy? Are people going to spend it? So these are also issues that need to be thought about. How will India compare versus others? We already looked at a chart showing the US versus India, but if you take that to the global scale, right? How will India compare to other emerging economies like Brazil, Russia, China, right? And what implications could that have for our currency? Will we have scientific breakthroughs that make managing this easier? All of this, obviously there are no right answers to this, but you have to weigh the probabilities in your head of how likely something is to happen and how unlikely something is to happen. And based on that, you can start asking questions about your portfolio. So once you have a flavor of what you think is going to happen in the economy, then you need to turn to your portfolio. What am I invested in? And how does that match up with the risk I see in the market? Are my safe assets large enough in quantity to see me through this time? Or do I need to shift money from a risky bucket to a safe bucket? What is my holding power? I could think that the risks are very low for the economy in 3 years, that we're going to bounce out of this in 3 years. But I may need money for my daughter's education in 2 years. So holding power is your ability to keep your money in the market without touching it and without selling it. The longer you're holding power, the longer your ability to withstand volatility in the stock prices. Next is, how much do I want to limit downside versus maximize upside? So if this will depend on your stage in life. So for example, if you're retired, you're more interested in capital preservation than you are in wealth creation, right? And then how exposed am I to currency weakness? One of the big issues with global crises like this is that different countries handle them in different levels of ability. So currencies can move around basis how badly impacted countries are relative to each other. This doesn't make a big difference if you're only in one country, but if your business, for example, has exposure, if you are an exporter from India, this could actually be a good thing. Your costs will be in rupees, and your revenue will be in foreign currencies. And if you think India's currency will weaken, that will help you. But let's say that your son lives in the US and you visit him quite often, right? You're going to end up spending in dollars and earning in rupees. So you need to think about how to hedge risks like that as well. So if we move on, in terms of general advice, and again, you must do your own thinking around this, but here's the kind of conclusions that we drew in terms of our own thinking around it. So for safe money, is it better to be in a short duration or an overnight fund or an FD? So when you talk about safe money, this should be money where you prioritize safety and not return. Don't look to maximize your yield on safe money. Look to maximize your protection and your safeguard your principal, especially in times like this. So you may have noticed that we've moved some of our Wealthsimple customers into overnight funds. They pay a lower return, but they're very safe. And unlike in FD, they're liquid. So you can always move out of the overnight fund when you feel more confident of what's going on. In terms of individual stocks are very risky assets if you've not done your homework. So the first step is do your homework on your stocks. Make sure that you know what's going on with these companies. If there's ever a time to dig in and to learn about your companies, it's now. And if you can't understand a company, the safest bet is to sell it. In terms of value traps, a lot of things look cheap right now. And there's a reason they look cheap. So the reason is that the market perceives them to be very risky. That doesn't mean the market's always right. In my past avatar, that was my job, to find instances where the market was wrong and you had cheap stocks that were not risky, right? So you can always find bargains, but you need to make sure you do enough homework and ask yourself enough questions to understand why it's trading at the value that it's trading. Okay, now let's move to equity funds. A lot of you probably have money with third-party managers. So the number one thing you can do at this time is to understand the manager's strategy. So a lot of the fund houses will have literature on their website about how the fund works. You can look at the fund's holdings and see and ask yourself, does it make sense to have these holdings right now? You can look at the industries they're invested in and use your judgment and say, if they have a lot of exposure to high risk industries and you think, that the risk in the economy is pretty high, then you may want to consider shifting your money, right? Or if you feel conversely that things are going to rebound, then you want to be in sectors that are perceived to be higher risk. So number one thing with equity funds is make sure you understand the strategy and look at the fund holdings and try to do a little homework there. Other considerations is, like I said, currency devaluation is a risk here. One of the best ways to hedge against currency devaluation is to take some exposure of gold in your portfolio. We don't recommend a very large exposure, but for most people, having a little bit of gold is a good idea in times like this. And the best way to do that is to buy an ETF. You don't actually need to buy physical gold. You can buy Gold Bees ETF, which tracks the price of gold. So that's another tip that we have. So before we conclude and move to Q&A, it's very easy in times like this to lose your head and lose your cool and get very nervous. But I just want to point you guys to a very interesting chart. So this is the US stock market from 1900 to today. And what you'll notice is if you go to 1929, that's a very famous date because that's the date right before the Great Depression, which was one of the biggest economic downturns that we've seen in modern times. And if you notice in this chart, you can barely even see the decline. And the point here is that over long periods of time, periods like this do not matter because we will get through this. We will manage to fight through COVID. We will emerge stronger. It's just a question of how long this restructuring will take. Some people feel like it could be a V-shaped recovery, some people a U-shaped recovery, some people an L-shaped recovery, but there will be a recovery. So I just want to leave you with that note, and then we can jump to Q&A.
Yeah, so we have a couple of questions that have come in. How should an individual think of whether to invest in an index or actively managed mutual fund?
Okay, so great question. So, an index fund, so for beginners, an index fund is basically a fund that invests in a broad range of stocks that look to track the overall economy. So think of the Nifty, for example. You can buy an index fund that tracks the Nifty. So funds like that tend to be safer because you're guaranteed to perform in line with the market. But basically, you will not beat the market in terms of performance. So some investors like going in the active route where they try to invest in an active fund to outperform the market. So my advice here is if you have a concrete view and you've done your homework and you have a point of view on the economy and you think, you know what, I think this sector is going to really perform well. This active manager seems to be targeting that sector. I like his strategy, then it's a good idea to be in an active fund. If on the other hand, you are not sure what's going on and you're in an active fund, I would recommend you move to an index fund right now because the chances are that all industries and all companies will not be hit equally. You're already seeing this. So for example, if you look at companies in the financial space, Bajaj Finserv, Bajaj Finance, HDFC Bank, even Kotak Bank, ICICI Bank, RBL Bank, you're seeing stock prices get hammered in the financial space, right? So if you were in a fund that tracked financials, you would be performing far worse than the market, right? So the real question here, I would recommend for members, unless you've done your homework and you have a reason to believe certain sectors are going to outperform, stick to an index fund.
Okay, so the next question is, how do you compare 2020 with 2008?
Yeah, so I'm going to kick this over to Sanjay. He's done a lot of good work on benchmarking versus the last recession. So he's got some good thoughts. And I'll jump in after with some additional thoughts.
Okay, so I think the first thing to understand when you compare 2008 and 2020 is that 12 years have passed. Right? So the Indian market is much bigger and much more mature than it was in 2008. So in 2008, most of the Indian banks and people like that, they did not really have exposure to subprime paper and things like this. Yet the Indian market fell because it fell in sympathy with the US market. So the good news is that now, if it was a US only crisis or a global crisis which did not affect India, then probably the Indian market will not fall, right? Because it's much bigger and it's much more mature. There are more people doing SIPs and so on. However, this time around in 2020, the problem is that this is not a crisis which is limited to one country or one sector or one segment, whatever. It's pretty broad. And this lockdown affects almost everything. Right? And the second thing to be a little more concerned about is that the Indian balance sheets, both of individuals and of companies, have slightly more leverage or debt than they used to have in the past. Like in the past, Indians used to save a lot, they used to hardly borrow a lot, they were very conservative. But slowly that has gone away, right? And now they're pretty leveraged. So this thing, so that would argue that the 2020 effect could be worse. And Sahil talked about some of the things about how, the amount of stimulus India can do, etc., could be less. But again, some of the things is that, like, uh, in the long run, like if the world becomes more digital, if people want to diversify their supply chains, and so on and so forth, this could be very positive for India. So at least in the framework, when I was thinking about it, one of the things that I thought was that there may be pain in the short run, but if India reacts well, and that is, I'm not only talking about the government, but I'm talking about the industry, I'm talking about us as people in India, etc., then I think it could be very positive for India. So the way I view it is that this could almost be like a 1991 moment. And India does fantastic in terms of crisis. And so if things become bad, I think India will come out swinging. So anyway, to cut a long story short, and Sahil, then you can add, is that I am sort of not that optimistic in the short term. I don't know what will happen in the short term, but I'm very bullish in the long term.
Yeah, I think that was a good summary. Look, I think one of the key differences between this time and last time was something that Sanjay alluded to, which is while you're not seeing an expansion in public debt levels. So just for beginners, this is, you're not seeing an expansion in the amount of debt at the country level. So the country hasn't borrowed a ton more than it had at the time of the Great Recession. But you're seeing an expansion of borrowing at the individual and the corporate level. And so credit, by the way, for beginners is just another word for loans, borrowings, bonds, etc. So credit has grown at a CAGR, so CAGR, that's for beginners a growth rate, average growth rate, has grown at a CAGR about 3 times that of the GDP growth rate. So that means that over this period, both individuals and companies have taken on more financial risk on their balance sheet. So why is this important? So think of yourself as a company for a second. Let's say think of a company as a person for a second. So let's say that, I saved a lot, had a big savings cushion. COVID hit, I lost my job, and I knew that 4 or 5 months would be bad, but I'd be able to bounce back. Not a big deal. I have a savings cushion, I can manage. Now, on the other hand, imagine that I had bought a big house, had a big mortgage, taken out an EMI to buy a TV, fridge, this, that, and didn't have much of a savings cushion. My ability to weather and make my payments through that downturn become more difficult. So this is one of the most important things when analyzing individual companies through this period. You need to understand their balance sheets very, very well. So when I look at India as a whole, the debt levels are higher than they were, materially higher than they were in '08. On the other hand, India is under leveraged versus peers. So when you look at the total debt in the system in India relative to uh, you know, almost any economy that we benchmark against, China, India, US, Russia, Brazil, our debt to GDP ratios are lower in terms of private credit. So that is one thing that could potentially help, but I do think that this is going to be more challenging than '08 from that standpoint.
Okay. There is a question on, one second. We saw some buybacks and acquisition happening during this period. Can you share your views on that?
Yeah, so buybacks has been a very sort of contentious topic in the US as well. So for beginners, what is a buyback? A buyback basically means a company uses its profit to buy back its own shares. So think about this like saying that, uh, if I buy back shares in the market, the remaining shareholders then own a bigger portion of the pie than they did before, right? So that's why companies do it. It helps them raise their earnings per share, and it helps existing investors earn more for the same price they paid. The problem with buybacks is it doesn't invest in the economy, right? When you buy back shares, you're not investing in the company itself. You're investing in basically the financial securities of the company. So you're not expanding the company, you're not creating new jobs, you're not doing anything for the economy really. You're just inflating your share price, right? And the problem with buybacks and why buybacks could potentially come into the picture here is that when companies buy back shares, they make the company itself more risky, because instead of saving this money for a rainy day or paying down debt or reducing their borrowings or investing in growth, they're using those funds instead to raise their stock price. So it makes them less resilient to a downturn. Similarly, with acquisitions, acquisitions obviously have a business rationale. If you find a good company to buy that can help you generate what's called synergies, if you can turn 1+1 into 3 essentially. So, for example, if I am Hindustan Unilever and I go and buy a small food producer, because I have so much scale, I can buy that food producer and raise their prices because I have more distribution power. That's an example of a synergy. So acquisitions have more of a business rationale, and they're better than buybacks, but acquisitions also typically come with high levels of debt. So a lot of companies use loans to finance their acquisitions. So that also strains companies' balance sheets at this time. If you made a big acquisition before COVID-19 hit, it'll be tougher for you to manage through the recession. So think about it this way. Let's say I bought a huge house, right? I acquired a huge house. That's like an acquisition for me, right? And now I'm sitting with a big mortgage and big EMI, right? It's much more difficult for me to manage when things get bad. Similarly to companies.
What's your opinion of RBI gold, sovereign gold bonds versus gold ETF?
So I'd have to come back on this question. I've not studied the RBI sovereign gold bond. I don't know, Sanjay, if you have a view on this or not.
No, I have also not studied it. So you can just send that question to advisory. If we
We'll
find
study
something,
it and then, yeah.
we'll study it and revert. But here's another good thing, when we are talking about understanding, right? So these days, almost any question you have, you can type it into Google now and you will find out something about it, right? And in quite a few cases, you will find out more if you do your own homework, because otherwise you will trust the homework that an expert does. And, so I would encourage people, and the other thing is there is this concept of what people call FOMO, which is the fear of missing out. So there are lots of people who want to understand everything about everything, right? That, in my opinion, at least, is a bad idea. So if you kind of keep it simple, then you're fine, in there.
Next.
I'm going to leave out the questions on the small cases because I'm guessing we'll have a separate session on that. The Indian markets also respond based on US market sentiments. In that, if US economy won't we get impacted? Okay, so won't we get impacted if the US economy is impacted?
So this is a great question. This is a very insightful question. So this is something I've been noticing also as I've been monitoring our small cases and our funds and all that. It is very clear that the Indian markets look to the US markets for price guidance. So if the US market is up, chances are the Indian market will be up. If the US market is down, chances are the Indian market will be down. The Indian market was down today, the US futures were down today, right? So there is a price leadership absolutely by the US. Now, this, in my view, creates opportunity for investors. It does not make 100% sense that you always look to the US for price leadership in a time like today, because countries are going to be very different in their ability to manage this. As we looked in the chart, the amount of firepower the US is bringing to the situation versus in India is vastly different, right? And this to a large extent is going to impact domestic firms quite a bit, right? Because think about the services sector, restaurants, haircutters, retail stores. These cater to a completely domestic consumer. So I don't think it makes so much sense to look to the US to for price leadership. And also, even in their COVID journey, they're in a very different point than we are. If you look at our curve is linear on a logarithmic basis. Theirs is actually flattening. Our cases are much less, right? But there's still uncertainty about how this all will unfold in India in a way that there isn't so much uncertainty in the US. We've kind of seen a leveling off there. The question there is, can we ease up on the restrictions and still see the leveling off?
Okay, there's a question on, asset allocation. If a person, does it make sense to continue with 60-40 equity to debt if a person's horizon is 10 years?
So does it make sense to continue 60-40 equity debt?
Yeah.
So if the person's horizon is 10 years. So I think this is a personal question that everyone will have to do their homework on. There is nothing, that I can, there's nothing wrong with what you're saying. 60-40 equity debt at this point in time could be a great solution for you. It also could be a suboptimal solution for you. I think the key questions is you got to put it through the framework that we walked through. What life stage are you in, right? How important is your safe bucket and risky bucket? Are you adequate? Does 40% debt protect you enough, right? In terms of having an adequate safety cushion. Are you generating income right now? All these factors play into making the right decision for yourself. And also what your view is on the economy. We've walked through our view, right? But we could be totally wrong on this, right? I mean, if you joined our last session on stocks, you would have seen a slide that says even the best investors in the world are right 55 to 60% of the time. If we take the converse of that, that means they're wrong 45 to 40% of the time, right? So I think listen to the points that have been discussed here and the factors that matter, and try to make the decisions yourself, with our guidance. And if you have further questions, reach into advisory@Bharosa. We'll try and assist you through that venue.
Yeah, I just like to add one more thing, which it also depends on the size of your portfolio, because these percentages are not that meaningful. Sometimes the absolute amounts are more meaningful. And also it depends on the tax situation that you are in, possibly. So if you decide, say, oh, I'm worried about the market, so I'm going to come down from 60 to say 20% equity. So I'm going to sell 40% of my equity. Now that may have a tax impact. It may be a loss which you can carry forward for 8 years and so on and so forth. So it does get a little complicated in that, but ultimately, it's not that hard if you sit down and then you take all these factors into account and then you make your decision. And what Sahil said was very important, that if you feel you need an advisor for specific advice, then it may help you to pay an advisor to get specific advice, and that specific advisor may not be Bharosa. So Bharosa will make you more educated to have a better conversation with a very good paid advisor who gives you specific advice.
Okay, so there's a question on people who were already in small and mid cap and they've obviously bled like never before. Uh, does it make sense to sell or does it make sense to stay if they don't need the cash?
So great question. So look, I think the reason small and mid cap mutual funds are bleeding is a reality of how this downturn is going to impact the economy. Larger firms, by nature of their balance sheet and scale, can generally manage these times better. They usually have access to larger credit lines. So think of a credit line like a credit card. So if I have a very high credit limit on my credit card and I run into trouble, I can use it to manage. Uh, Generally, smaller firms, they don't have access to these liquidity measures. So I don't think that necessarily that price movement is irrational. So the question you should be asking yourself is that as I look forward, if I believe things are overblown, and I think the economy is going to rebound relatively quickly and quicker than most people expect, then small and mid cap funds will outperform, probably. Even that's not certain, but probably, if I were to bet, they would probably outperform because that becomes less of an issue then. That liquidity issue becomes less of an issue. If, on the other hand, things take longer to uh, resolve, then I could see small and mid caps continuing to underperform. So Anup, this is really a question that should be turned back around to you, and you really need to come up with your vision of what's going on. You've heard our vision. We are very conservative right now, but if you disagree with it, then you need to adjust your portfolio, and don't let the fact that you've lost money influence what's right to do in the future. Because when you've had a loss, you can book the loss, you can carry forward the loss, reinvest the money, right, in something that you think makes more sense. And as that gains, you can offset those gains with the loss. So uh, generally, and this is a common psychological pitfall that all of us run into, even professional investors, etc., all run into this problem of, man, I lost so much on this stock. I just got to hang in and it'll recover, but that's actually not a rational thing to do.
Okay,
Yeah,
I think
one other thing is that, if something has gone down and like the market is really down, so it may be keep falling like a knife, or it may come back. Like if you see this recent movements, it fell to 7,500 on the Nifty, and then it came back, right? And then who knows what's going to happen going forward. So you might also like to see if you can sell when there is a bit of a rebound, if that's possible. Okay. So those are some of the things that you can think about. But like Sahil said, that what price you bought at is irrelevant. Okay.
Actually, I'm not a fan at all of so-called technical analysis and charts and all that. I know a lot of people employ these strategies and all in their trading, but that really is trading. It's not investing. So, if you're expecting a rebound, it's got to be grounded in some kind of point of view that's investable. In my career, that's what I've seen that's worked. Anytime I've tried to look at the charts and make decisions, it's actually cost me money, not made me money. So that's my 2 cents. I know people will disagree with me. A lot of smart people, experts will disagree, but that's my honest feedback on that.
there's a lot of questions on evaluating individual stocks. To answer those, I think we are having.
Yeah, let me take that. I'll answer that question. So, you should never trust someone's opinion on an individual stock without doing your own homework. And we will also not give advice on individual stocks in good faith without doing a lot of work. So if you ever hear me talk about a stock and give advice on these sessions, it's because I've really done my homework on it and I feel comfortable in answering the questions, etc. Because that's really dangerous. And it's one of the things that I think a lot of advisors do, which is really harmful to a lot of people, is give off the cuff advice. I think that for my advice for individual stocks, the key things you gotta look at, and we're doing a session on stock investing every Sunday. So we've had one session. So for members, you can access the last session on the Learn tab in videos. You'll see the last session. And for non-members, you can look at becoming a member and accessing it, or you can find it on YouTube also. But basically the key right now that you need to be focused on is, what access does this individual company have in accessing a credit card of sorts? Okay, so these are called revolving credit lines or credit lines. So in the annual reports of these companies, they'll often talk about the access to these things. How much cash does it have on its balance sheet, right? You need to focus on this to see, does it have enough liquidity to see it through this time? That's one. Two is, how resilient is it to the recession that's happening? Is it a restaurant company? Is it a retailer? Is it a non-essential business? Is it a bank? Is it a, all these different companies will have different ramifications. So you need to analyze how sensitive it is to that. And you need to look at the basic, valuations also to see if they make sense, the PE that it's trading at. And I know this sounds like a lot of work. It is a lot of work. So if it's something that you don't feel comfortable doing, etc., then you should really look at ways to take insurance policies on that stock. In the sense, you can look at options to cap your downside. You can look at selling the stock or whatever, because we're going through a really uncertain time, and companies can really get hurt right now if things go bad. If things go good, they can rebound very quickly and you can make lots of money. But it's really like flipping a coin if you've not done your homework. And even if you've done your homework, you can make mistakes. So make sure the amounts are also amounts that you're comfortable with, right? If these are very large amounts, look at reducing some of the amounts.
Okay, I think that's it for the questions for now. If anyone's question got missed out, please send an email to advisory. We'll send it back to you. We'll respond back to you.
Great. This was a lot of, a very interesting session for me, and I learn a lot in presenting this. For people that like what we're doing, that the focus on understanding, the focus on literacy, please look at becoming a member of Bharosa Club. You'll get added to our WhatsApp group, so you'll be able to be apprised every time we're doing a new video seminar. You'll get access to our video library on our website. You'll get access to tools, and you'll be able to ask questions on advisory at Bharosa. We think it's a steal. It's only 1,000 rupees for a full year membership, and it's cancelable at any time. So would love you guys to join and be a part of the story, and please let others know about this. We're just starting out here, and we want to grow this to be something that really makes a difference to a lot of people. So with that, hope to see you on Sunday when we're doing our next session in stocks. Great, thank you all. And please fill our survey out so we can get better.